Some investors dedicate years to trying to outperform the market, while others take a completely different approach by investing in the entire market without making any changes. These are two distinct mindsets, yet both claim to be the best way to build wealth. So, which approach is truly correct? In this video, we'll explore one of the biggest debates in investing: active versus passive investing. We'll clarify the differences between the two, examine the data, and determine which strategy truly prevails in the long run. Welcome to Martic Finance, where we simplify investing concepts. A quick disclaimer: this is not financial advice. First, let's define the two strategies. Active investing focuses on trying to outperform the market, typically measured by indices like the S&P 500, which tracks the 500 largest U.S. companies. If the S&P 500 rises by 8%, an active investor aims for returns of 10%, 12%, or more. Instead of buying and holding an S&P 500 index fund, active investors select individual stocks, bonds, or funds they believe will perform better than the overall market. To succeed, they rely on research, data, and timing, analyzing company reports, financial trends, earnings, and market news. Common active investing strategies include individual stock picking, where investors buy and sell shares of specific companies they expect to outperform. For instance, an active investor might invest in a company with strong fundamentals that hasn't yet seen its stock price reflect its true value. Alternatively, they may focus on sectors they believe in, like renewable energy or technology. If individual stock picking isn't appealing, investors can opt for actively managed mutual funds, where a professional manager makes investment decisions based on thorough market analysis. Active exchange-traded funds, ETFs, also exist, which offer similar benefits but trade like stocks throughout the day. Active investing has its advantages, such as the potential for higher returns if smart decisions are made, flexibility to respond to market changes, and opportunities across different markets. However, it also has downsides. Consistently beating the market is challenging, and management fees for active funds can exceed 1% per year, cutting into long-term returns. Additionally, it requires significant time, effort, and expertise to research and manage investments. On the other hand, passive investing takes a different route. Rather than attempting to outperform the market, passive investors aim to match its performance, usually through index funds or ETFs that track a market index like the S&P 500. By investing in these funds, you effectively own small portions of numerous companies. The philosophy is straightforward. Instead of trying to pick winners, own them all. Passive investing has several key advantages. It's low cost, as index funds and ETFs don't require expensive management fees, often charging between 0.3% and 0.20%. It's also simple and time-efficient, sparing you from extensive research and market monitoring. Historically, passive investing has shown strong long-term performance, as markets tend to grow over time, and it helps avoid the emotional stress of frequent trading. However, passive investing has limitations. By design, passive investors cannot outperform the market. They can only match it. The strategy can also feel dull due to minimal active involvement, and investors are still vulnerable to market downturns. When comparing active and passive investing, the data reveals a clear trend. According to the S&P Indices versus Active report, 80% to 90% of actively managed funds fail to outperform their benchmarks. This means that even professional managers with extensive resources often earn less than straightforward index funds. A famous example is Warren Buffett's 2008 bet, where he challenged hedge funds to outperform a basic S&P 500 index fund over 10 years. By the end of the bet in 2017, the index fund returned about 7% annually, while the hedge funds averaged less than 3% after fees. Research also shows that most individual investors underperform both the market and professional funds, not due to bad luck, but because of emotional decisions. They tend to buy when prices are high out of excitement and sell during downturns out of fear. These emotional reactions, combined with high trading costs, diminish returns over time. Active investing can be beneficial in certain situations, especially for those with the knowledge and discipline to conduct thorough market research. Investors focusing on smaller or lesser-known companies or utilizing institutional resources may uncover opportunities that the broader market has overlooked. However, long-term evidence overwhelmingly supports passive investing. Its low costs, diversification, and compounding power make it challenging, even for skilled professionals, to outperform a simple market tracking fund. Additionally, passive investing fosters better habits, encouraging regular contributions and minimizing emotional trading. That said, if you enjoy analyzing companies or exploring emerging sectors, consider allocating a small portion of your portfolio